Good afternoon, and welcome to IHA's Webinar Wednesday for Shared Housing One Size Does Not Fit All. Today, our presenter, Dino Moeller, currently serves as the Executive Vice President of Client Solutions for LeSaint Logistics and Operating Office. Dino is currently Chairman of the Board of Directors for the Transportation Marketing and Sales Association. Since joining LeSaint in 2005, Dino has led the company to the explosive double-digit growth. Dino has over 30 years' experience in supply chain management, logistics solutions, and strategic business development programs. It gives me great pleasure to introduce Dino. And one quick thing, everyone, please ask all questions at the end. Dino has allowed quite a bit of time to answer any questions. Once again, Dino?
Great. Hello, everyone. Thanks, Jenny. I appreciate the introduction. Leading LeSaint is a combination of a lot of folks, but we're excited about our growth and excited about that opportunity. Good afternoon to everyone, and I hope everyone is safe and in good spirits, if it's afternoon or morning from wherever you are. What we're going to be doing today, as Jenny had said, we're going to talk about shared warehousing. But let me give you a little bit of the idea of why. As we continue through the year and talk not only to IHA members and CHESS contributors, but also prospects and customers that are in the marketplace, there's lots of topics that continue to rise as we look at efficiency, as we look at improving, and more importantly, as we look at creating sustainable models for growth and navigation of growth. Shared warehousing is one of those concepts. So this is really about feedback topics that we've gained from insight from folks that are on the phone and to folks that help us run a very large sector. So it's exciting, and I feel privileged to be able to share some idea creation. What we're going to talk about is shared warehousing. And shared warehousing is not what the old term of public warehousing is. This is really a step above and a step beyond, and it allows for agility and navigation of customers' growth in different categories. But with anything that is topical, there's also misconceptions, and that's what we're going to displace today. When we say one size does not fit all, what that is saying is that a dedicated facility specific to one customer may work in some scenarios, chemicals and other different things, but there's a value in looking at a shared warehouse, especially if you're in a growth or expansion mode. The misconceptions really enter in three different columns. And as you can see on the screen, the first one is the misconception is shared warehousing limits your ability to make goods retail ready. The number two is fall short of efficiencies and scale of a dedicated warehouse. And number three is the lack of flexibility to meet dynamic supply chain needs. I'm going to focus on these three misconceptions, but the path we're going to take is looking at 6 myths that really fit under these three columns. And we're trying to find a myth that may fit into your business challenge or business opportunity today. And as Jenny said, I'm more than glad to answer any questions at the end. You also have my contact information if I can address anything one-on-one that you feel not to ask the question. The second thing, even though LeSaint is hosting this, and we're going to use many of our customers and some of our best practices as practical models, this is really an advocation for you to consider outsourcing and outsourcing with shared warehousing, if it isn't just with LeSaint. We're a very big advocate of this industry. So I want to try to stay neutral, but you are going to see some references to some of our capabilities. But as you address questions, I will stay neutral in that area. So let's move on to the very first myth. Getting your goods retail ready is more difficult using a shared warehousing model. What we find in this myth here is that it is displaced and dispelled for a certain reason. Shared warehousing is only the idea of sharing resources, the resource of the building, the resources of technology, of labor. So being able to be reactive and also customized to retailers' requirements as it relates to retail readiness. And retail readiness to LeSaint is that last level of value before it's consumed. It may be tickering, kitting, some type of postponement manufacturing, things of that sort. So adding an additional value right before consumption or before the shipping experience happens. We do it today in many cases. And the ability to do this is about having the right technology in place to do configuration. It's about having the right knowledge. What the shared warehouse gains is if when you build the idea of the retail requirement, then you build the shared resources around it. Still having standard SOPs, still having high quality compliance and regulatory factors of the retailer or the consumer or what have you. It's more about sharing the resources so that you can manage costs and in many cases create agility and speed. And that's where we find that shared warehousing doesn't limit you. And in fact, in some cases, it can enable you because you take best practices and shared resources and you can speed the process up. You can take larger volumes faster because you just have a shared environment. The second myth is omni-channel fulfillment becomes more complex in a shared warehouse. Omni-channel, defined in the industry, is about taking orders from various locations. It could be your shopping cart, via phone, a website, standard order, and so forth, and then fulfilling them whatever channel they are, if it's a B2B or B2C. And in this case, we use Bodum as an example. We supply their specialty channel, their big box channel, online channel, mom and pops that may not have all the EDI or APIs and things of that sort, and then direct to consumer, that doorstep. We're still meeting all of those channels because what shared warehousing does give you the ability, again, it gives you the ability to configure differently. It allows you, again, by the technology to have warehouses within warehouses, meaning if you have a product SKU that's very focused on customization to specialty and it's different than big box, you don't have to separate. You really do have the ability to still meet it. There is not a challenge, and the dispelled is that it does still give you the successful reality of meeting them. There's just some stats on a case study that, yes, it does actually work. This isn't just wordsmithing. And we do it for several clients as it's done in the industry. The shared warehousing doesn't limit that ability versus a dedicated. The third myth is because of standardization or standardized nature of shared warehousing, you can't achieve the same levels. I think this is where shared warehousing versus public warehousing kind of gets the bad name. And nothing against public warehousing, but public warehousing is really more about pallet in and pallet out, non-technology, not a lot of value add. So that idea of standardization. What we find though in shared warehousing is that you have the ability, because there's multiple clients. In a shared warehouse in our network, and about 80% of our facilities are shared warehouse, we do have dedicated, very customized to a customer that has a unique product need. We find that we're able to share processes, either best in class or next in class. We're able to share the configurable WMS technology so that we can use it to share labor and things of that sort. And overall, it just helps the general efficiency. Some of the things you find when you're doing this is that you reduce errors from having the paper-free environment. So you're sharing costs, gaining a technology, staying on the leading edge, having the ability to configure. You're also able to invest differently. So you're sharing, again, costs. I think that's a big level and in accuracy, but also in this is about labor. You're able to share labor in that idea. But shared warehouses versus a dedicated or public in that case is that you're gaining the efficiencies without having to absorb all the costs in seasonality, low peaks of the week, low peaks of the month, or high peaks of each of those also. So it allows you the higher level of agility and customization without breaking the bank or limiting that you have to invest heavily in capital versus in sales and marketing, whatever your model may be. The fourth myth is really more around the difficulty of managing returns and volumes. And we bring this up due to the fact that many customers in our network in the past have had multiple points for outbound fulfillment and a separate facility for returns. And that may be that channel model that they have, But in a shared facility, you can do both. You can manage your outbound. You can also manage your returns. And it doesn't limit it to the fact that it's, dedicated. What we find, and the reason this is dispelled is, again, it's about configuration. It's about the technology. It's about having the resources. And as most of you know, if you deal in the world of returns, they're not a flat line across the entire year. You have surges. If it's big box, there's totally different surges. If it's consumer, it has a lot of not only surges, but it may come in any type of package, and sometimes not even the box or the branded box that you fulfilled it in. So you still gain the efficiencies around shared warehousing as it relates to returns. Shared warehousing, from a configuration perspective, still is driven by standard SOPs. It's still driven by scope to customer, scope to retailer, compliance to retailer. It isn't just a big, massive warehouse and throw everybody in it and manage orders. You still are configuring space to specific customer needs, customer requirements, and channel requirements. We manage several returns today in consolidated facilities that are shared, managing those both on the returns and the replenishment, refurbishment, getting them back to retail ready, repackaged, reboxed, and still in a shared environment, giving the client the opportunity to look at cost and efficiency management versus the idea of, build it and they will come. Not that we don't look at trends forward, but we're more of a believer in let's grow as it grows, navigating growth from the investment or capital or scope perspective versus in a dedicated warehouse. If you have growth that's abundant, you may have a facility that you outgrow very quickly. And one of the largest costs of going to a new building is the transition cost, the moving your inventory, retouching your inventory, potentially reconfiguring a building and reinvestment. So this really does help fit in, and that's, again, overall value, I think, of shared warehousing as a total. The fifth myth, shared warehousing generally incurs the same fulfillment and distribution costs as the dedicated warehouse. And I think, as you've already have heard through some of the commentary that I'm sharing, is there's a different value. At LeSaint, we do transactional pricing, cost plus pricing, and price plus. And the idea is to continually look at advancing. And advancement in our 360 logic, which is a methodology we use, it's not only about cost, but it's also about efficiency. It's about improvement of process and things of that sort. But to dispel that idea that you have the same cost isn't necessarily true. In many cases, in a shared environment, you enjoy a lower cost in certain areas. So in capital, you're using and sharing one building. So you're only, if you will, costing the portion of the building that you may use. You're only using the portion of the racking as capital, the technology investment, other things that are sitting in that building that become part of your cost buildup model. Technology is another one. Technology today, we run Manhattan and Associates at LeSaint, the scale version. It's very configurable. It is not inexpensive. And for a single dedicated facility to invest in a technology of that size and stay current really has a large cash. It's a very large capital decision for a leadership team to make. In a shared facility, again, you're sharing the portion of it. You're sharing the portion of that cost and spread out over, in our case, multiple facilities from licensing and RF guns and different technologies that we use. Those are two of the elements. I think one of the most significant element is the flexible labor sharing. Today, as we all have, at least what we experience with our customers, we experience seasonality. We experience end of month, middle month, first of month surges, depending on what sector and what channel. And then, of course, the consumer buys when the consumer defines it. So this allows us to be prepared from an agility perspective in a shared warehouse, especially if it's RF driven, to share labor. So when there's a surge, we first can create a baseline number of employees, And then as surges happen, whenever they happen, we either cross-train or we can pull from other customers to bring in to help that without going through or carrying cost. The technology allows us to do some not limited training, but faster acclimation to your SKUs as a customer, your processes, your picking requirements, and your retailer compliance. So it does give us a lot of capability and agility to work through those type of requirements. The shared warehousing, I think from a shared warehousing perspective, this is one of the largest myths that as you look at supply chain navigation from a growth perspective, from a reevaluation, this is where it does fit in. You know, it fits into the idea that you can expand a little more rapidly. You can respond to opportunities potentially with expanding SKUs or things of that sort. So it does give you the ability to think forward without making, you know, hard real-time investments and hoping that they move forward properly. And as most of you are experiencing, this market today has a lot of unpredictability. It changes with new competitors, new buying sources, new selling sources, all the things that we know are happening in this marketplace today. The idea of navigating the unpredictability is critical. And I think shared warehousing gives you that. Now, again, we run dedicated warehouses. I'm not saying that it doesn't fit in the right model, but what we've learned, at least 80% of the folks we're talking to gain value from the shared concept. And that's why we really want to displace some of these misconceptions, because it is a true opportunity for you to create agility into your supply chain. The last myth, as I've said, again, creates the largest opportunity is your labor strategy options. The myth is your labor strategy options are more limited in a shared warehousing model than in a dedicated model. One of the opportunities, and I've already attempted to cover this a little bit, but you know, some of the things that we look at is the idea of resources versus demand and demand growth. I've listed a couple of our clients. Some of these have different seasonality. So in a shared facility, you can align yourself from a configuration of customer and that seasonality overlap. They may have different surges if it's holidays, season, end of month again. So our approach, and even in a shared warehouse, is to look at the core and the dedicated labor and then flex it, labor across multiple firms. So have folks that are roaming. And we do this through technology. This isn't just what do we think we're going to do today or where do we need to put, you know, employee number one. It's really through labor management, understanding the demand from a forecast and visibility, and giving each of the customers an idea of having the ability and confidence and trust that the orders will be fulfilled and not have to wait for the investment or have folks sitting around waiting for orders or things to come in. I know that sounds relatively basic, but if you look at most of your costing models, there's two primary drivers. Labor is a monster one, and the capital, the building, the technology, you know, those things. Supplies all fit in based on, they're usually demand and facilitating the orders. Those are the two that have fixed environment type of potential costs. And they're also the two largest costs, at least in the multiple markets we're in. We're in over 14 markets that have the largest escalation. Labor cost, related to labor, of course, is benefits and things of that sort, and then the cost of space. Now, there's other factors, but those are the two largest drivers. So we really look at helping our clients manage not only the cost side of it, but the future side of that cost. So that as you look at cost per order or cost per line, whatever metric you use and whatever metric your 3PL would be managing to, it's important to know what's going to happen in 3 years. And it's hard to know what that is because of some of the unpredictability. But it's a better position to say, here's a strategy to help us manage through it. And that's really, I think, some of where this idea of labor management, and as we spoke a little bit earlier about capital management, starts to really fit in and drive a decision about focusing on growth versus focusing on structure. So, and that's really what this part of the process is about. Today, LeSaint and as other providers do, manage cross-industry best practices. And the reason I bring this up, this is another value that's not a myth. I think it's a value of shared warehouses, is that you bring in several different type of fulfillment requirements from different clients, different types of products. Not all are home and housewares, but very many are. But they are definitely consumer goods that are that are either high velocity, fast moving, or they are brands that are not only on your shelf but also at your doorstep. And we gain from that by putting them in a proximity. Sometimes it's a gain of a way to use the system differently. Sometimes it's a way to slot the warehouse differently. So there's a lot of knowledge gained, not only for yourselves, but from the third party who, based on what we feel our culture and our mentor is with our 360 logic, is to constantly be looking at advancement, making sure that we are bringing the next practice or a better widget to solution, whatever that requirement is. And where I think where shared warehousing does for you is it merges all these different supply chains with control, with process, with technology enhancement to drive a better forward navigation solution as your channel changes or your SKUs change, or even acquisitions fit in to give you some kind of agility from that perspective. I went through this relatively quickly, but it is something that we wanted, and IHA gave us the opportunity to just share some of the knowledge that we're gaining and questions that are coming up from our customers about other ways to look at their supply chain from an advancement, an improvement, and a forward direction. And this was one that we felt made sense to share. If you're an emerging brand, if you are a mature brand, or if you're a brand that is looking for diversity, I think shared warehousing has that opportunity to give you a driver's seat view versus a reactive view, and in a defense posture, it allows you to be more proactive as you navigate your supply chain. One of the things you'll see, and if you want to look at more of this, there's a complimentary infographic that will be sent to the emails following today's webinar. It really capsulizes what we just spoke of. It gives you some reference points. And as I'd indicated before, I'll be more than glad to address some questions. But at the same time, please, if you want to go, you'll have the ability to look at that case study or infographic. There's a lot more case studies on our website. And any questions that are addressed here, or if you want to have a one-on-one question, here's my contact information. I'd be more than glad to address. And again, I will stay neutral. I'm really more about wanting to make sure that the right solution's found and we can take that path. So, Jenny?
Great, thank you, Dino. We do have a few questions. One is, my business is increasing year over year. How does the shared warehousing model help me?
Great question. And I think, as I've addressed, what it does, it gives you the agility to grow. And I'm assuming when you say business is increasing, it's throughput volume. I'm not for sure, I assume it's growth that's organic growth. Organic growth is probably one of the larger challenges to navigate because it's forecast driven. Typically after it happens, you've already had to experience it or react to it. And I think that's where shared warehousing gives you that flexibility. It allows you to flex up and down, as we've covered, both from a technology, capital investment, but more importantly, labor. It allows you to be able to, respond as it's happening beyond sitting and looking backwards and go, wow, we just had a great year. How did we perform? In some fixed warehouses, dedicated warehouses, especially if it takes you out of the walls or takes you out of the labor capability, then that growth can be stressful. And then, in fact, it could be more costly than sustaining. So I think it gives you the ability to be agile and again, back in the driver's seat of your growth.
Okay, we have one more, another one for you, Dino. Do you offer billing invoicing service?
So the industry in general does, but depending on the retailer, and I assume you're meaning billing the retailer for your goods. We do today for a select few of customers. So in that relationship, we're actually billing for their product. So that means we know their costs. We're responsible for that. In this case, it's an ASN billing communication. We're not responsible for receivables, but it is a backroom optimization that you can do. I found that very few clients, because of the contractual responsibilities, always want it because of the information share and so forth. But yes, we do it, and it's done in the industry.
Perfect. Another question. Our business model is increasing SKUs and product lines. Does this limit my space within a shared model?
Yeah, so I think it's, again, the same question. So here's how we build a model in general. So it's a cost buildup. We first look at what's your forecasted, or what's your as is, what's your today look like, and then what's the forecasted model. And that forecasted model may be from throughput through value services. And then we define what that space within the shared space would be. The shared space always has that ability to flex. So adding more SKUs, and I assume this means count, doesn't limit it. It's just, again, that ability to flex and grow together. Product lines, I assume maybe that's similar to the SKUs. I think where it gives you the great ability is, especially if you're changing the configuration of the SKU. Meaning, if today you're doing, coffee makers, and you're going to just modify the color of the coffee maker, you're not really changing the requirement, the slotting, or the warehouse configuration. But if you're making X product, and now you're going to add a new product that maybe is 3 feet taller or 2 feet wider, or has sensitivity to temperature or things of that. And that's where I think a shared facility gives you the ability to change how you're storing it. It gives you the flexibility to change it. If you're entering into more value add, where you're taking, say, kitting 3 SKUs and can be becoming a master SKU, that gives you that ability to fluctuate in between. So increasing SKUs, I think, is, if that's the path, shared warehousing gives you some flexibility, because it's not set one way, and then you have to reconfigure the whole building to adapt to a different SKU count if the size changes. If the size doesn't change, again, it fits right back into I think the first question. It's about growth. It still gives you flexibility. It may make some changes of the configuration structure. Is what I think.
Okay, we have another one. We are currently only in brick and mortar. Does adding e-com or B2C limit me in a shared warehouse?
Yeah, I think I think we covered it a little bit. The channel that you fulfill, as long as the right technology is in place and the right methodology of handling an omni-channel or multi-channel needs, it doesn't change the advantage of a shared warehouse. It enhances the advantage in the fact that, especially if you have shared SKUs that are going to go to bricks and mortar, maybe by layers or pallet count, that same SKU is going to be fulfilled to e-com. So in that case, you don't have to carry multiple SKUs or backstock or multiple shipping inventories. It allows you to have a little bit of flexibility. And most of our customers today we are servicing their channels, all the channels, from a shared facility in a fulfillment structure. So I think it can just enable that change in channel. And we've had lots of customers that have started bricks and mortar and added e-com or B2C, and vice versa. Started out more of a .com and started to go into maybe more specialized retailers. So whichever path you start off and whichever path you grow into, I still think it enables that. And again, not saying that dedicated facilities can't do that. It just really depends on how big of an investment structure are you looking for, and do you require that you're the only company or product or SKU or brand in one building. And that may drive, especially if you're manufacturing and fulfilling out of the same building, that drives it. If it has some type of, like I said, in sensitivity to environment, that may drive it. So there are some of those, but in general, overall, I think it enables your ability to change channels or expand in channels.
Great. Dina, we have a few questions that are pretty much pertaining about charges and billing. Would you like those questions to be directed to you privately? They can email you?
Yeah, are they, does somebody want to quote? So, yeah, no.
Yeah, minimum monthly or annual billing you need, things of that nature.
Yeah, that's probably easier to drive directly to me, because that seems to be more of a specific conversation. You know, right. In general, when we look at embracing or engaging with a prospect, if you will, we do a lot of discovery up front. So we're really, if you look at our 360 Logics, if you visit our website, throwing a number out there is purely a number. It's really about what is the solution and the best path. So we do a lot of discovery, then we do creation. So, you know, to give you an idea of a .com average cost per line, we can talk through that. But where your product's coming from an inbound perspective, where is it going? Is there reverse logistics? Those all fit into a total landed cost. And that's really, we want to talk cost versus price. So it's really hard to answer a cost question without getting to a kind of a price answer. And price, for me, misleads the idea of, you know, your total return on your outsource investment. So yes, Jenny, I'd rather have those directly. Oh. And if you email them, I will address them.
Okay, great. We do have quite a few questions here for you, Dino. Are there, and you might have covered a little bit of it, but I'll repeat it. Are there monthly expectations that one would expect from the shared warehouse model, whether it be number of SKUs, warehoused, or order transactions?
Sure. So, and I think the question, it does fit into the minimums, it fits into the size of customer and things of that sort. And we go through a go or no go, which is meaning, one, can we add value? Before we even think about minimums, from the type of product, can we add value? Can we advance them? Can we enable and help their growth? And would they fit into this shared environment? So saying that is really about making sure culturally we can bring value at the end of the day to the customer, and the customer will also experience that same value. When we talk about minimums, dependent on the market, and this is where there's all these caveats of comparison or qualification. If somebody wanted 2 pallets in Broken Knee, Wyoming, there's probably a minimum. If there's a shared warehouse in Chicago where we have a campus of a few facilities, there may be a minimum, but it isn't a stop forward. It doesn't say if you don't have 10,000 square feet, we don't want to talk to you. So it's relative to that. Space isn't always the driver of the opportunity. It's about turns. It's about your throughput. Most e-com today, which is, you know, compared to historical, has a smaller footprint. Typically, you're turning the product faster, and the configuration of your product. If your product is the size, you know, of your finger, and a pallet has 3,000 units, is way different than if you have 2 units per pallet. So space isn't always the driver. It's more about the throughput, and that's where the solution fits in. Most are going to have some type of minimum. Most are going to have some type of you know, agreed forecast requirement. But I wouldn't get stopped to say I have 1 pallet. It's configuration. I wouldn't stop to say I have 30,000 pallets. It's still about the configuration of your SKU and your pallet and your turns. So yes, kinda to the answer, but I think it's not real complicated, but it's really about more customized to your need. Even in a in a shared warehouse, that's why I point out there's still customization. It's about resource management. Hope that covers it.
All right, popular, Dino. We have a lot more. We are currently using 3PL services in shared warehouse, but we are the first dynamic client with omni-channel fulfillment. We feel our growth is limited and the growth is directly related to cost. What do you think about that?
So, and again, I don't know, I think some customers, always the first, may feel that, could feel that in our warehouse, it could feel it, but I think it's a reality of, one thing we do quarterly business reviews, and some are monthly, and it isn't always about looking backwards, it's about looking forward. So I think if that's the feeling of the environment, that you're absorbing more of the cost, or you're the driver of the learning curve, things of that sort, I think if you're not doing some type of periodic, stop the train, let's stop and let's look at our growth, let's talk about our forecast, let's talk about our business needs today compared to what they were yesterday, you should do so. And I think that helps you just navigate through the growth. If you are 80% of a shared warehouse and the other 20% is there, you're going to be the larger piece of it. The shared warehouse value starts to get a little dismantled because there's only maybe 20% of it. You're still gaining the flexibility in some of the things, but that degree. Now, what would be good to know from the third party is what's the growth path. If you're at 80% of a building and you still want a shared environment, what's that next expansion from a bringing you back down to 50% of the building or something of that sort. So I really think that the key here is to be open about your concern and to be open about the directional forecast path that you may have with your channels and with the customer. It's not an uncommon reality. People grow fast, especially in today's world. And, the shared, if you look at Chicago for us, 2 years ago, we had a single facility at X thousands of square feet. And then within 18 months, we're now at 3, double all that space. It's a reality that you want to make sure your third party has the agility to grow and change, meaning don't just expand the walls and add more customers, but look at the footprint from a campus perspective.
Well,
that's a good question, though. It's a real good question. It's a reality question. So, very good. Thank you.
It seems as if the next question you pretty much covered some of the aspects, but I'll read it again so this member can hear her question read, and you might be able to give additional insight on something. In shared space, what happens when all the companies grow and you outgrow your building? How is that handled? I know you pretty much covered most of that earlier.
Yeah, and I think that's, if you look at markets of Chicago and California, we really are focused on markets that cover as much population in a 1 or 2 day reach as possible. So those are typically the markets that grow rapidly. And as my example about Chicago is, our company, which other companies can be the same, really look at our growth as a strategy. So as in Chicago, grew out of the building, we immediately expanded. Now, that means we're going to move a customer to another shared building, and typically, and most commonly, it's at our expense. It isn't something we burden the customer. Now, we have a lot of customers that come to us that their current third party, they basically just outgrew, and that third party does not want to expand to other markets or expand to a bigger footprint. Doesn't mean they're not a bad provider, that just means that's their strategy. Our strategy is about growth. So we want to enable our customers, and our tenure, we've been around for going on 34 years. We have customers that have been with us for 33 and a half of them, but at the same time, average 15 to 18 years. So, our reality to our customer is we grow with them. So some of it's about your selection of the provider, but it's also your challenge to make sure as you grow, that provider is keeping pace and can keep ahead of you to make sure that you continue to grow, if it's channel, SKU, what have you. So we answer the question directly. We expand more, we get more buildings, we get more space, we grow.
Okay, I think we have one more, and I believe some of this was covered as well. We've been using a warehouse company for years now. How do we know when it's time to expand into a second location? What are the factors to do this?
Great. Well, I think there's a couple questions there. One, you know, changing warehouse companies is it's a business decision. You know, we have a very large 96.7% retention ratio. So I'll be the first one to applaud, you know, retention. I'd be the first one also to say, if you're going to make a decision to move from a current provider, to make sure it's a strong business decision and it's a true reason, not an emotional reason. But expanding to a second location with your current provider, or bringing in another provider, or completely changing to one provider to do two locations, it's really driven on a couple of factors. And it's factors that we constantly are looking at with our customers. It is about the supply chain. It's about your inbound nodes. So where your points are, if they're changing, that's always a time to reevaluate, either one location or the location, or to two. Where you're outbound, you know, if you change channels, if you're going from bricks and mortar and adding e-com, and that e-com is going to be a significant part, is a great time to analyze where you should be, because the bricks and mortar are locked locations, and they're typically using LTL and truckload. Where you start entering the consumer, you may change even the mode of transportation, which then carries different costs and different evaluations than other types of modes. So anytime I think that there's that type of change is a good time to evaluate. It doesn't mean you'll make the change, because then it may say, hey, we're at 22% of change when we're at 30%, let's really look at changing. So if something significant happens in your supply chain. The other reason is, as I covered a little bit, is just pure growth. You know, there are some really great providers that want to stay in one market. And I don't want to call them mom and pops, but because they're not just mom and pops, but they may be just really marvelous in a market. And if you need to change markets because of those nodes or those inbounds and outbounds that we spoke of, or because the footprint's too small, or the technology's not been invested in, whatever, then that's a business reason. You know, it's not an emotional reason. That's a true business reason to say we need to evaluate it. I think at a minimum you should challenge your provider. We do it to at least look at what you look like every 6 months, from a trend of throughput, trend of configuration of lines, orders, and what have you, at a minimum, because it allows you to continue to navigate. Change happens fast, and I think the worst thing you want to do is to have an opportunity to grow and not being able to because of resources, labor, location, anything of that sort. So yeah, those are the factors. I think it's one, is something significant happening with your supply chain, or is there something that is stopping your growth from a negative view to stop. Doesn't mean you change. It does mean, though, you ask the questions and you ask the hard questions, the ones that not everybody likes to answer, but are completely needed to be addressed.
Well, great. I see that's it. And I'd like to thank Dino and LeSaint once again for all their support and wisdom. And for those of you who have additional questions, please feel free to contact Dino directly. And for all of you who would like to spread the word, this webinar will be at www.housewares.org. And once again, Dino, thank you and LeSaint for all that you do in supporting IHA and our members. And for those of you who will be attending CHESS, LeSaint will be our host, our VIP host of the dinner and cocktail reception next month. So thank you very much. And once again, please join us on Webinar Wednesdays. Have a good day, everyone.
Thank you.